Ask the Expert. Long-term investment strategies for growth by Walter Updegrave. I most likely pronounced that wrong. Written Thursday, July the 1st, 2010 on CNN Money. This is the article which is enclosed in the more information box, and some of you may want to read the article first in its entirety, figure out what's wrong with the article or what I may be stating within the article. For I will read bits and pieces of it at a time and then put my commentary, which has already been written on this document. And when we look at the header, ask the expert. So the question or the start of this is asking somebody who knows what they are talking about. And it is regarding long-term, lot of years, investment strategies for trying to make wealth grow. And strategies are situations which can give you an advantage. Something you work hard to try to figure out what's going on, thus practice the strategies you come up with. So it will be interesting to see what kind of strategies there is. And what I will do is the black sections are from the article, the blue sections is what I was writing in last night. And Walter, who is the author, has several books that deal with economic growth, including Investing for the Financially Challenged and Making a Heck of a Lot of Money, and many others. I guess if this guy is the real deal, he is going to give us some incredible strategies. And the question is, I have $200,000 invested today that I would like to grow to $800,000 over the next 24 years. What return do I need to earn on my investments for that to happen? Nancy from Quincy, Mass. This is such a complicated question that, well, I was learning this type of stuff in high school math. Because the question is how much do you need per year? And the answer was on a theoretical level, using theory. The answer to your question involves nothing more than some simple math. The kind of gain you're shooting for requires a 6% annualized return, assuming you'll reinvest your gains each year and that those gains will also earn 6% a year. Of course, to earn 6% annualized, you don't have to actually get 6% year in and year out. You could earn more in some years and less in others. This is the expert we are given. Buckle in, boys and gals, for some interesting strategies for investing. Gold and silver was not mentioned. If he wrote a book on investing in challenging situations, then I guess he should know about it. I will add my commentary, and by stating within silver as the investment strategy, you can answer it with the same first paragraph, and then put this in the second one. So the same first paragraph is on the theoretical level, blah, blah, blah. Silver is a safer investment over slavery digital fiat dollars. Of course, with silver, to earn 6% annualized, you don't have to actually get 6% year in and year out. You can earn more in some years and less than others. Because of heavy volatility within the COMEX market, those gains and losses can be sick. In 2008, it had a huge peak while making a fall of almost 60% in over one half of a year. Normally, this is brutal to take, but this does come with an intrinsic guarantee of its real usages. Because you're only looking for 300% in a time frame of a quarter century, your odds are quite decent in obtaining that level. Maybe even in the next year or two, the way our economy is dwindling. I have to laugh when I say that, which is why I put the LOL there. So, back to what he says. For brevity's sake, to use an example over a 3-year span, earning 10% one year, lose 2% the following, and 10.5% the next year would also work. Oh baby, 8% this year, light, and down 39%, and up 110%, and down 29%, and up 250%. That's what you get with the silver market. It's aggressive, what can I say, but we'll read on more from what's in this article. But while this is all fine in theory, in the real world, you're still left with the issue of actually getting 6% annualized on your $200,000 over 24 years. Real world. can you explain why this real world of banking slavery will continue over the next 25 years? And he moves on. Given the current low level of interest rates, I don't know of any investment around that will deliver that return guaranteed for 24 years. Investments that offer guaranteed returns, cash derivatives, treasuries, securities held until maturity, and such aren't paid anywhere near enough. Why is that? Is this because interest rates are at all-time lows and the dollar is not good? For silver, you may have to pay a small premium above spot. And this guy doesn't know of investment firms that take 6%, but silver can be bought for small fractional percentage points above spot. It doesn't matter the spot price if you are buying today, whether it is 24 an ounce, which may not even be seen in 2010 when you are looking for a gain of 300%. What I mean is if you're buying this at $24 an ounce, when the jig is up, it's not going to matter if you worked your butt off to get 50 cents or $1 or $2 above spot, or if you're forced into getting $4 above spot. It really doesn't matter much, especially for the long-term trader. He continues on by stating, so as a practical matter, if you want a realistic shot at turning your 200 grand into 800 by the year 2034, you're going to have to put your dough in a diversified portfolio of investments, such as a combination of stock and bond mutual funds. The key word here is potential. When you invest in stocks and bonds, you may do spectacularly well some years. A 50-50 mix of equities and bonds earned 17.4% in 2009. Fare poorly in others. The same blend lost 16.4% in 2008. And get so-so returns in yet other years, which is 4.3% in 2005. Practical manner, he said. Practical means putting into practice, and thus putting silver in your safe or in a location that is very strategic is the new practice. This guy refers to your money as dough and says diversified portfolios. 2008 showed that there is no such thing as a diversified portfolio. And I say this because everything got hammered. So you can say, well, I want basic materials, some energy, some gold stocks, some financials. That's not diversified, in my opinion, because they can all go up and down together. He told you a 17.4 loss in 2009. That did better than silver that year, but we'll see how the paper system does. Experts have not seen this paper trick, and I put sad laugh in because either they know what they're not telling you, which is scary, or they haven't figured it out, and well, that's pretty sad myself. Moving on, he states, the point is that the return you will earn is uncertain. In fact, recent research suggests that stock returns in particular may be even more prone to up and downs, and that was previously thought by investors. Read that final line again. Read it 3 times. Prone to up and downs that investors previously thought, or more prone to them, more prone to ups and downs. Have you seen the 100-year chart of the Dow? Is this how you tell us that the stock market is a major form of gambling? By saying that it's prone to up and downs. I know it is, and the jig is up. I'm no expert like you, but the return of silver is uncertainty. It may go up 200% or 2,000% or 20,000% and have some wild swings along the way. The uncertainty of its intrinsic value is very low. That is very certain. There can be many transitions that may happen. Silver energy has good boom potential cycles that it can take what photography no longer requires with silver. The best part is if you are looking to invest in many years, you have a new currency that's covered. If 2020 brings a new currency because of the current one dying or something like that, then the 2020 currency is available as long as silver is still used, meaning you can exchange that silver for whatever that currency happens to be within its market value at that time. Your major risk is investing is a major larger inventory supply to be appearing, meaning a heck of a lot more silver comes in, which thus would reduce the value of it because we have so much of it that we can do all these magnificent things more often. To hedge your bet, do your damn homework on inventory, and when you see it as reflecting danger, start to short the physical or buy some option puts. If that game is up, meaning the game of puts and shorting is up, then I don't know how to hedge. But if you listen to this guy, then your 200K may be done. And he continues on stating, so you really need to be thinking in terms of the probabilities of having a various amount of money in the future. To get a sense of those probabilities and how they can change if you invest more aggressively or more conservatively, you can go to Morningstar's Asset Allocator tool. Experts who predict probability odds have very good track records because of them being an expert. An expert plumber can fix any related disease I meant to say any related plumbing problem. That's what I meant to say. I guess a doctor expert can fix many diseases. So we'll just take a plumbing problem in here. But he is likely not to be an expert in investing. Let's see his expert probability guesses. That tool he talks about seems a little fishy. So for example, if you go to the tool and plug in the amount you have, 200K, your goal 800K, the number of years in which you want to reach your goal, which is 24, and then use the slider to create a simple portfolio of 50% large company stocks and 50% bonds, you'll see that the tool estimates you have a 21% chance of achieving your goal in 24 years. That's strategic. 21%. And that is 79% you do not. Wow. Myself feels that getting 300% at any moment within the next 24 years is 99% with silver. That is 1% that it does not. It may not make you that much on an economic collapse, but it sure as heck will save your butt if it does happen. And the odds of the economic collapse are big, and I don't need to scare you with another big number, but it is over 90%. It also shows that you may do a lot better in the financial markets if the financial markets perform well. For example, you have a 10% chance of having almost 1 million or more. How will the financial markets do better? Where are the probability odds? 10% chance of making 1 million and only a 400% gain. With silver, it is 99%, in my opinion, for 4 times return, and it is 99% for a 5 times return, and heck, maybe even a 96% chance for getting better than 12 to 1 on your money. I can only calculate what I see, and it is not like we know exactly what the future holds. We do know many things like how the dollar is created and how silver is created. Silver gives you security of real money. If a crash happens, that will have the value written on it. If you want paper as an asset, buy some computer paper, line paper, notepad paper, and so on, but not 200,000 or 5K maybe, and maybe even 2 or 3K, because you can do something with that paper. Continuing on, he says you'll find that you can significantly increase your odds of reaching your goal by investing more aggressively. For example, the odds of having 800K in 24 years jump to 31% if you invest 70% stocks and 30% bonds. And your upside also climbs significantly. There's a 10% chance you'll have at least 1.3 million. And I have to reply with more aggressively? ? You gave her dollars. If you are an expert, you should know that's very risky with the heat of the Greek debt crises. The truth of how our money is created that is going widestream, mainstream, and the value of the US dollar index longer term chart. You are saying to risk aggressively. Risky asset classes in a game that is more aggressive. That is super aggressive. And he goes on stating, but there's also a risk that comes with investing more heavily in stocks. Your portfolio will experience more volatility and uncertainty. So while the tool estimates that a 50-50 portfolio has a possible 3-month loss of roughly 8%, it figures a 70-30 portfolio can drop more like 11% over the same period. How does that tool know the investing strategies? Obviously, if they paid the experts, they would be winners because if the person is investing in stocks, then it's either her picks or her odds are based on how good of a guesser, researcher, gambler she is in comparison to what you have in the game. I figured the experts would be people who can kick ass in making money, that they would bet extra share sizes or smaller share sizes for clients while charging fees that are lower than a profit. Some good day traders and swing traders that also make great at making profits. For example, you have a day trader that with a $1 million equity account makes $24,000 a month. Well, then a bunch of people ask, "Can you invest for me?" Next thing you know, he's got $5 million for a bunch of people. All the profits get split evenly. He makes a fee for their service, yada, yada, yada. But you know that doesn't work that way. There's also a potential long-term price to investing more aggressively. For example, the tool projects that even if the financial markets do very poorly over the next 24 years, with a 50-50 portfolio, you have a 90% chance that your $200,000 will grow at least $312,000. If the markets turn against you and you're invested in a portfolio of 70% stocks and 30% bonds, on the other hand, you have a 90% chance of having as little as $290K. It's 2010. What's the chances of Dow 80K? It's unfortunately possible now, and it would be a lot more scarier than Dow 3000. Dow 8000 should translate, however, to 1000 plus with silver, which is a sick gain if you're getting a $24 a coin at a premium. This guy's projection is a tool. If it can't figure out that it has a decent chance of going to 200 million, and of course 200 million doesn't sound like it's not like it means too much. For if you have Dow 80,000 stocks, like I say, it will be a lot more scary than 3,000. In short, the higher volatility of returns that inherent in a more aggressive stock-intensive portfolio gives you a shot at higher rewards if things work out well, but leaves you with considerably less if markets deteriorate badly. Well, he is right on the ball with this one. Give this guy a round of applause. Well, you can stop it now, because this line is correct. And it says because of his investment advice can deteriorate many, meaning it can lose a lot. I don't want to suggest that by going to this calculator you'll be able to know with pinpoint accuracy your odds of reaching your goal. All these figures are based on projections, and projections are squishy by their nature. Pinpoint accuracy. Are you kidding me? Do you think she is that clueless? Okay, she is. And you are still saying this to her. You can teach diversification and not get 200,000 worth of silver. Instead, maybe 80K in silver, 20K in gold, 30K in long-term food and health supplies, 40K in multiple currencies and paper and melt form, not digital, and maybe 30K in miscellaneous. That is diversification in my view. How you do in the real world will also depend on the investments you choose. Again, no guarantees here. But I think you can tilt the odds in your favor by sticking to a low-cost investor-friendly funds, like those that appear on our list of recommended funds. Probability odds that the recommended fund that are very risky and contain poor results, I am guessing it is 100% in fiat dollars and not be good. I once again would have to give you that scary big percent of the dollar falling. And he goes on stating, that said, I think there's a value to going through the sort of exercise I just described. I've limited my example to mixes of large company stocks and bonds, but you can choose the tool sliders to create portfolios with different combinations of large, small, mid, and foreign stocks, bonds, and cash. You can also very easily extend or shorten your investing time period and periodically invest new money to your portfolio if you wish. So we talked about all of these different things that you could be buying. Stocks is cash. Bonds is cash. Cash is cash. They tell me if I wish I can invest more. Are you serious? You got No diversification because everything is in fiat dollars. Moving on. By doing this, you'll come away with a better sense of how the investment world works. You'll see in actual numbers that the higher the returns you shoot for, the more volatility you must accept. More important, you'll see that while investing more aggressively may lead to greater rewards, it can also lead to much more meager ones if things go wrong. Yeah, you'll see how it works all right. He put the meager word in, right down in here. If things go wrong. And I say the ha-ha like Nelson months after he says it, stating, it can also lead to much more meager ones if things go wrong. Ha-ha! Something like that. And he finishes off by saying, bottom line, whether you're investing in a goal like retirement that's decades away or something shorter term, incorporate uncertainty and volatility into your planning. Allow for the very real possibility, indeed the likelihood, that you won't get exactly the return you're shooting for. Consider you may end up with something less. And then build in a cushion by saving more or giving yourself more time to reach a goal. Better yet, do both. This article is going to be read by many who don't get it, and some of them may take the advice. Hopefully it will be read by many more whom are at least able to detect some degree of bullshit to the story. This article was not written by an expert, because a real expert would see the odds of a financial collapse to be high. And it's not an expert at lying unless this is one poor article for your standards, because the BS meter was massive on this.